This week in the S&P 500, we've seen the best day in 2024. We can see the majority of stocks up in the green, looking very well. However, when we do zoom out over the last month, semiconductors have been very mixed. We've seen some good performances like Nvidia, like Broadcom, but also on the other hand, we see some very poor results like Qualcomm, like Intel, as well as many others. Now today we are focusing on 7 undervalued semiconductors with massive growth potential, and the reason for this, as we've discussed many times, the AI market is set to be around 1.3 trillion by 2032. Now this is from Bloomberg. They did release this last year, and they talk about how over the next 10 years they're anticipating 42% growth on a year-on-year basis. We also have an article from PwC who are bullish on this industry. They talk about how they see the AI market going up to around 15.7 trillion, adding that to the global economy, and they are talking about just the next few years up until 2030. That is why today we are looking at buying some incredibly strong companies with massive growth. As always, we're going to look at each one's historical performance. We'll talk about the rating summary, what the analysts believe. We'll touch upon their dividend safety. Now, each one does pay a dividend, although not a very large amount. And we'll also talk about dividend yield theory, look at their forward P in relation to the 5 years, as well as some very important financial metrics. And we're also going to run each one through our valuation model, talking about our own intrinsic value, what Wall Street are forecasting, their upside, which we said would be quite significant, and the margin of safety that we see within each one of these 7 semiconductor stocks. Now, before we get in, just to let you know, we have released our latest free weekly article. We run through what super investors have been buying, as well as the stocks they've been selling. If you want access to this or any others, it is completely free, and you can grab a copy by clicking on the pinned comment below, where we also run through our 35 undervalued stocks for your consideration in August, as well as those that we hold within our own portfolios. So do check that out below. First semiconductor we're touching upon is Micron technology, where in fact today we get a double strong buy. Wall Street and Quant, we also get a buy from Seeking Alpha, and this one is trading in the mid to lower end of the 52-week range. As we said, each one has a yield, Micron with 0.42%, and we can see in fact it does have a very high forward P sitting at 89. Over the last year, it is up around 70%, and as we can see, over the last 10 years, up 233%, significantly outperforming the S&P, and in fact, in 2024, we do note all-time highs around $160. Now, very briefly, when we do look at their earnings per share over the last few quarters, very nice to note, over the last 4, they have beaten management expectations, so that is a 100% track record. Now, we don't have the next 2 quarters, but we can ultimately see in quarter 2 and quarter 3 of next year, they are anticipating triple-digit growth, and if they do hit that, that is massive growth. In fact, 948, the forward P will come down to a lot more reasonable target at 11.46. Now, when we look at the dividend safety, it does sit at 60, borderline safe, and they in actual fact haven't increased their dividend since 2022, but do bear in mind their share price return has been fairly strong. And for those that do want to know, it was reaffirmed just last month that ultimately there is a moderate risk of a dividend cut over a full economic cycle, and we will look at that as we go through. Now, in terms of the last recession, they had negative 18% sales. Bear in mind that was below the average growth of the S&P, that did sit at negative 12, and we just touched upon dividend growth, and when we do take a look at it, they have been paying a dividend for the last 2 years without a reduction. As we said, dividend yield theory, what it states is a company is undervalued when the current yield sits above the 5-year average. Right now it isn't too far off, so you could argue reasonable valuation based off on this model. In terms of the forward P though, it does sit much higher, 14.6, than the 5-year that we see of 6.9. And when we take a look, the information technology sector does sit much higher at 26.4. As always though, we won't conclude on any of these models in isolation, and we will take a look at it through the valuation model shortly. First model we're looking at is the free cash flow payout. Now remember, below 50% for semiconductors when we're industry specific, and what we do in fact note is over the next 12 months it is anticipated to be around 16%, which is fairly low, so we would expect a very large increase. When we look in 2023, negative 8%, this does indicate to us that their free cash flow per share has been negative, and we can clearly see that in 2023. Now, as we run through these today, bear in mind the industry it does operate in is very cyclical, so we will see a lot of peaks and troughs. And when we look at the free cash flow of any company today, we want consistent increases over the longer term. Not something we get a lot with Micron due to the cyclicality, but as we can see, in fact, 2 of the last 10 years have been negative, including 2023. However, over the next 12 months, it is anticipated to increase to around 280. And again, we do note that cyclicality. While we want to see 3 to 7%, we have in fact 5 of the last 10 years negative, including the more recent of 2023. But we also note on a trailing 12-month basis, the expectation is for 2024 full year to have some nice double-digit growth to the top line. Then when we get to their total sales, for those that want to see it numerically, 16 billion in 2014, hitting its peak in 2022 of just under 31, and then we note that drop in 23, although we can see, as we mentioned, on a trailing 12-month, it does look to be moving in that right direction. ROIC is a very important metric. Personally, we want to see 10% or more to give us faith management are able to effectively allocate their capital. 12% for semiconductors, and it has been straddling around that, not as consistently as we would like to see, but just something to bear in mind with this company. We can't really get a lot of consistency, and that is shown right there throughout the models. In fact, on the operating side, whilst we want to see 16%, in 2023 we get negative 35%, although previous to that it has looked very good above the level, but again, do note that inconsistency, which is also shown throughout their free cash flow margin. Now, in terms of the net debt to EBITDA, remember below 1.5 for semiconductors, EBITDA referring to the earnings before the interest, tax, depreciation, amortization, and the numbers that you can see here are the number of years it would take the company to pay off all of their debt net of cash on hand. Now, it does look very, very mixed. We have some years with 0, we have some years above, and in fact, with the more recent year at 2.05, that is probably why we do get that borderline safe score. But the impressive thing here to note is over the next 12 months, it is anticipated to come down very sharply to 0.31, which ultimately gives us faith that there are no issues with that dividend, and we should expect what I believe to be double-digit growth moving forwards. Then we're going to jump into the intrinsic value, and as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $138 is purely from the DCF model. Now, when we review each company, typically we will go through each model in detail, the inputs and outputs. We'll start by showing off for the first one, but for the rest we will just get straight to it. So we have the free cash flow year on year for MU. Now, the average growth rate is fairly skewed given we have some years of negative, some years of positive. And today's episode, we have gone for a triple rate, a low, medium, and high. And we've gone for the growth rate of 15, so the middle rate. Bear in mind, as we saw at the beginning, a 42% compounded annual growth rate is expected in the AI market. With a discount rate of 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get that intrinsic value. And with that 138, that ultimately tells us there's around 28% upside. Now, bear in mind they had negative free cash flow, as we saw earlier in the metrics as well. We have taken their 2024 starting point as what management are anticipating for the full year. And for those that believe that is way too high, well, for transparency, we will show you at a 10% rate that comes down to around $100, ultimately meaning downside of 7%. And for those that believe that is way too conservative at 20%, that does bring us to around 189 with 75% upside. Now, we will take the 15% median rate to essentially the final calculation, but as always, these numbers are very subjective, and if you want to put your own numbers through, you can grab a copy of this model by clicking on the pinned comment below, whether that's for MU or any other company that you so wish. So moving on to the intrinsic calculation, at 138 then we always use a margin of safety, and we always start off with 10% and execute on that if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that, we'll buy at $125, and then we keep going till it's near the current trading price, and we can see in today's episode you are getting at least a 20% MOS. For those that want 25%, around 104. So with a 20% MOS, Wall Street considering this a strong buy as well as quant, with Seeking Alpha giving this a buy. We see 56% upside with their price target at 168. As always, give us your thoughts below. 20% MOS in today's episode with 56% upside from Wall Street. We then move on to Marvell Technology with a strong buy from Wall Street and a double buy from Seeking Alpha from Quant. This one's trading in the mid to upper end of the 52-week range, a 0.34% yield, a 51 forward PE, although we will see how that compares over the next year. And over the last year, up 18%. Over the last 10 years, up nearly 400%, significantly outperforming the S&P. Remember, if you reinvest dividends, it would be up slightly higher. And we do in fact note all-time highs December 2021 around the $90 mark. Now, in terms of their performances, well, over the last 4 quarters, they've actually been in line in the previous 2, having beaten in Q3 as well as Q2 of 2024, although we do anticipate over the next 2 quarters a negative growth year on year, with the subsequent 2 being strong growth. And if they do hit their January 2026 EPS estimate, the forward P will come down significantly from 51 to just below 30. Now, in terms of this company, we have another borderline safe score of 42, and we are still waiting on their dividend increase for the full year of FY24. And when in fact we look at those recessionary metrics from the Great Recession 07-09, they didn't pay a dividend, so no comparative data. They had below average growth at negative 25%, and they pretty much had an S&P return of negative 54%. Now, dividend growth pretty much showing us they have kept it very, very continuous from, in fact, 2014, as we can see. So they have been paying a dividend for the last 11 years without a reduction. However, they have 0 years currently of dividend growth. Now, in terms of dividend yield theory, then we do get a sign here of small overvaluation, with the yield being lower than the 5-year. We also note the forward P does sit higher at 43 versus the 5-year 33.7, and we do note it is significantly above information technology. But as we just ran through, if they do hit those EPS estimates over the next few years, it will come down, in fact, substantially. We then can see on the free cash flow payout pretty much below 50% nearly every year, in the 19 to 20% over the last 2, 21 anticipated over the next 12 months. And when we look at the free cash flow, again, just bear in mind this industry very cyclical, so it is very up and down. Over the next 12 months, very marginal decrease anticipated. And when we look at the sales growth, again, we do in fact note 4 of the last 10 years have been negative, notably 2024 at negative 7%. And when we do zoom out and look at it, 3.6 billion in 2015, 5.5 in 2024. So there is growth over the period, but again, very inconsistent. And when we do look at these shares outstanding, we can in fact see they would have diluted your position as a shareholder over the longer term. 521 in 2015 to around 861. But again, you probably wouldn't care given how strong that share price has increased over the last 10 years. ROIC not looking the greatest, as in fact it is very clear, it is very inconsistent, but in fact from 2020 it does look very, very poor. It's negative 2% to 2% in fact. And when we do look at the operating margin, we do get that sense of inconsistency throughout. However, the free cash flow margin does paint a much nicer picture. In fact, from 2018 looking very, very strong, well above that minimum 5%. And in terms of the net debt to EBITDA, this is essentially where we do get that dividend safety score driven. Remember, it does correlate to both balance sheet strength and dividend safety. 1.76 in 2024, 1.74 over the next 12 months. So we do get it marginally above what we want to see. Ideally, very similar to Micron technology, we want to see it reduce and fairly dramatically over the next few years, just to give us a sense both in the balance sheet as well as the dividend. We then move on to the valuation, where we have a $90 intrinsic value, not dissimilar from Wall Street where they have $92. They see 30% upside, and when we do run it through the calculation, well, a 10% MOS, a buy at $81, at 15% around 76, and at 20% pretty much around today's price. So if this is something you are interested in, we see 20% MOS with Wall Street, 30% upside, and in fact, as we just saw, they do consider this a strong buy. We then move on to Qualcomm with a double buy and a hold from Quant. It is right now pretty much trading in the midpoint of the 52-week range, with a yield just below 2% and a forward P of around 17.4. Bear in mind, S&P right now around 23. Over the last year, up 57%. Over the last 10 years, up 123%, marginally outperforming the S&P. And when we do look at their performance, looking very good over the last 4 quarters, a beat 100% track record, and also looking very strong over the next 4, meaning if they do hit that September 25 figure, the forward P will come down to around 15.5. In terms of their dividend safety, well, we have a safe score and the first one that has increased their dividend very recently, 6.3% in March this year. Always good to see, and above that inflationary target of 4%. And in terms of the dividend, well, they increased it during the last recession, above average growth, and also significantly outperformed the S&P with their negative 21% recession return. They also have an increase of 5% over the last 5 years, but an even more impressive 20% increase over the last 20 years. 20 years as well of consecutive increases, meaning they are 5 years away from becoming a dividend aristocrat. And in fact, when we look at dividend yield theory, we do get a marginal sense of overvaluation on the yield. However, on the forward P, pretty much in line with the 5-year, giving us that reasonable valuation signal. And we do note one of the cheapest valued in terms of the sector, information at 26.4, Qualcomm sitting at 16.3. Then we talk about this company in terms of the payout ratio. Now below 50%, again what we see for the majority of the last 10 years and over the last 3 years. 2024 anticipated for the full year 31. So again, we should see at the minimum an above inflationary increase, and actually a very, very good free cash flow per share, as it is increasing nearly double over the last 10 years and anticipated to go much higher over the next 12 months. With their sales growth, no surprise at all. In fact, what we are noticing so far in terms of a trend, 2023 hasn't been the greatest year for these semiconductors, which is why the share price has suffered in comparison to others in the industry, but so far they look to be very good in terms of the MOS level as well as the target upside. And importantly, you need to understand with cyclical stocks, we want to buy them when they are out of favor or have had some overall bad performances, but the key is to ensure they are still some very high quality ones. So how does it look numerically? Well, it has gone from around 27 billion in 2014 to 36 in 2023. What's also good to note is they have returned excess cash to shareholder pockets through some significant share buybacks over the last 10 years. Always great to see. And the ROIC looks very, very good, consistently very, very strong, the best one we have seen so far in terms of this metric. And their operating margin also looks to be very, very healthy. Whilst we don't get any operating efficiency, which is where the margin increases over the longer term, we don't get any massive movements up and down. Overall, it is above the minimums and does still look to be healthy, especially in 2023. Free cash flow looking very strong as well, well above the minimums, 34% on a trailing 12-month basis, also looks very attractive. And very nice to see in terms of the net debt to EBITDA, never been above that 1.5 maximum level we want to see. 0.35 in 23, 0.1 over the next 12 months, so a very strong balance sheet, and as we can see, dividend does look to be secure. Now, whilst our intrinsic value of $210 is lower than Wall Street of 225, they see 30% upside, but we still do see a nice MOS level. For today, a 10% would be a buy at 189, at 15% around 178, and it isn't quite there at a 20%. So for Qualcomm today, we would say somewhere between 15 to 20, with, as we can see, Wall Street very bullish on Qualcomm with 30% upside. And do give us your thoughts. Some of these you may find very attractive, some of these may not be the ones for you, and we would like to hear your reasons why in the comments below. We then move on to ASML Holdings, where we have another double buy and a hold from Quant. This one is trading in the mid to upper end of the 52-week range, a yield of 0.71% and a forward P of 45 currently. Over the last year, significant outperformance of the S&P, up 41%. The same to be said over the last 10, up 858%. Now, in terms of their earnings, well, looking very strong. They have beaten over the last 4 quarters, and also very impressive to note, some great growth anticipated to the EPS. And in fact, if they hit their December 2025, so that is the end of next year, then in fact the forward P will come down very significantly to 28.54. We also note for the first time today a very safe dividend score at 82, and we can see their growth at 4.8% in July. Whilst it is good, it is above the inflationary target, as we are about to show. That is much, much lower than what they have on average. They also cut the dividend during the last recession. They had below average growth and pretty much had an exact S&P return of negative 55%. As we said, historically, they have increased that dividend at a very strong rate, 24 over the last 5 years, 26 over the last 10, and they have also been increasing those dividends for the last 14 years. Now, when we talk about this company in terms of dividend yield theory, we actually get our first undervaluation signal on the yield, but we do note the forward PE is pretty much in line with the 5-year. And in fact, when we look at the sector PE, information technology does sit lower. Then we look at the free cash flow payout in 2023 at 74%. No surprises then why this year was a very mediocre increase. Over the next 12 at 15% does give us hope we can go back to the ways of ASML on the double-digit increases. And when we look at the free cash flow per share, it has increased dramatically over the last 10 years. But in fact, from the highs of 2021, it has started to decrease. Over the next 12 months, though, massive increase, more than double their free cash flow over 1 year. Then in terms of their sales growth, probably the only one so far where in fact over the last 10 years, every single year has in fact been growth and looking very strong as well, because when we look at it from a numerical standpoint, we can in fact see here very, very strong, in fact more than 4 times growth over the last 10, 6 billion to 28. And what they also do, although fairly trivial, are those share buybacks, 440 to 394, and even though it may not be something that you're very ecstatic about, it is still a bonus for a company that we would consider to be a dividend growth stock. In terms of ROIC, looking very healthy as well, especially the last 3 years in the mid to upper end at the 40% rate. And when we look at the operating margin as well, looking very healthy, some signs of operating efficiency, and free cash flow margin the same to be said, although 2023 was one of their lowest years, still above the minimum 5% target. In terms of net debt to EBITDA, this is the model student in terms of looking at that 0 right across the board, 0 over the next 12 months. It won't even take ASML 1 day to pay off all of their debt net of cash on hand. Now their current price at $933, we do have some nice MOS for what we would deem to be a very high quality company. At 10% a buy just over $1,000, at 15% around $980, and at 20% around $922. Now the share price is currently dropping at the moment, so you could argue it is near a 20% level in today's episode, and with Wall Street forecasting 26% upside, you could argue this is definitely one to seriously consider if you have no exposure to the industry, or in fact you just want to add a very strong high quality company. As always though, do give us your thoughts. Some people may disagree, others may have this on the watch list waiting for a lower price. We then move on to Applied Materials with a strong buy from Quant, a buy from Wall Street with a hold from Seeking Alpha, trading in the mid to upper end of the 52-week range, a yield of 0.76%, a forward P just below 25, and over the last year, very strong performance, up 42%. Over the last 10 years, another one that has significantly outperformed the S&P, 838%. Another one as well, love to see this. They've beaten analyst targets over the last 4 quarters by a nice healthy distance, and over the next 4 that is expected to continue, with the forward P in 2025 anticipated to come down to around 21.52. Then when we look at the dividend safety score, well 86, very safe, and if that wasn't good enough, well a 25% increase to the dividend just this year. And when we look at the last recession, well, they maintained the dividend, they had below average growth, but they had a near S&P return at negative 57%. Very nice to note, over the last 5 as well as the last 10 years, they have been increasing that dividend at a double-digit rate, although we note only 6 years of consecutive increases, with 18 years of paying a dividend without a reduction. Then we talk about dividend yield theory. We do note here marginal overvaluation on both the yield as well as the forward P, although we do still note it is marginally lower than information technology sector. Then when we look at the free cash flow payout, pretty much every single year below 50%, 13 in 23, 20 over the next 12 months. Again, no surprises why we see those lovely juicy increases. And when we look at the free cash flow per share, in fact, very large increases over the longer term. Yes, it is very inconsistent, and yes, over the next 12 months, it is anticipated to drop. Nonetheless, when you do zoom out, it does look very, very good. Then we move to sales growth with only actually 1 year of a decrease in 2019, although we do see an increase to the top line at a lower level in 2023. Remember, 3 to 7% is what we want to see, especially for the more mature companies. And in terms of numericals, well, here it is, shown nearly triple in terms of the top line, 9 to 27 billion in 23. And we also love to see this, not only double-digit growth to the dividend, but they have bought back a very large amount of shares just over the last 10-year period. Then in terms of ROIC, very strong year on year and increasing. We love to see this, 30 to 40% just over the last 3 years. And when we do look at the margins, always a great sign when you can see a company that increases the top line as well as the operating efficiency going from 17 to 29%, with the free cash flow margin also looking very, very good. Net debt to EBITDA, nearly as good as it gets, not like ASML that we just saw 0 across the board, but in 2023 we get that as well as the next 12 months, which overall we do believe this to be a fairly high quality company. Wall Street give this 20% upside, price target of 250, with our intrinsic value coming marginally lower at 242. Now with our margin of safety at 10%, a buy at 218, at 15%, not too far off the current trading price. Again, it is a few dollars lower now the market is open, so you could say 15% MOS for AMAT, with Wall Street giving this a 20%, and as we just saw, a buy signal. We then move on to Lam Research with another double buy and a hold from Quant. This one is trading in the midpoint of the 52-week range, a yield just below 1%, a forward P of 24.6, over the last year up 32%, over the last 10 years, massive outperformance of the S&P, up 1,118%, and as always, love to see this. This company has beaten analyst targets over the last 4 quarters and by some massive distance, and over the next 4, they're anticipating double-digit growth to the EPS, with the essential forward P in June 26 to come down to 19.15 if they can hit their earnings estimate. Then in terms of the dividend safety, while a 66 score, it does look to be safe. A nice double-digit increase in August last year. So again, over the next few days, we are anticipating nice growth to that dividend. And ultimately, when we do look at the recessionary metrics, they did have below average growth and they did marginally trail with negative 64%. Dividend growth, beautiful sight to see here, 13% over the last 5 years, 46% over the last 10, and when we look at it from a numerical standpoint, they have been increasing those dividends for the last 10 years consecutively. Now in terms of dividend yield theory, again another one where we see a marginal overvaluation on the yield, but we do see that overvaluation on the forward P, 24 above the 5-year 19, and in fact not too far off the sector as a whole. So let's dive into their metrics, and the first one to discuss, as always, the free cash flow payout, below 50% consistently, 25 and 24, 24 over the next 12 months. So again, no surprises. We would love and expect to see double-digit increases moving forwards. Probably the most consistent increases to their free cash flow that we've seen so far in today's episode, with a marginal increase anticipated over the next 12 months. So off to a good start already. Although we do have to point out, like the majority of companies that we have just looked at today, 2024 or their most recent year does give us that negative signal of their top line, negative 14%. Although we can see when we zoom out, they have pretty much tripled their top line from 2015 to 2024. They've also bought back some shares, always a great sign to see, 177 to 132, on top of a company that increases their dividend at a fast rate. We love to see this. And the ROIC also looks to be very strong. So far, Lam Research does seem to be hitting all of the boxes, and the margins further confirms that, above 16% and operating efficiency. Free cash flow margin, again, not much to say other than we really like what we're seeing. Net debt to EBITDA finishing off as well with a beautiful metric here, 0 in 24, 0 over the next 12 months, 0 pretty much nearly every single year, so a phenomenal balance sheet as well. And when we look at the intrinsic value of $1,090, isn't this similar from Wall Street's 1101 with 27% upside? So what do we have as the margin of safety? Well, 10% a buy at 979, at 15% at 924, at 20% at 870. Pretty much today's price, we see a 20% MOS, and Wall Street see 27% upside for what we deem, as we have just gone through, to be a very high quality company. As always though, let us know if you agree. Maybe some of you will have LRCX in the portfolio. This is one that we have reviewed a few times on the channel that we do believe is one for some serious consideration. We then get to Microchip Technology with a double buy and a hold from Quant. This one is trading at the lower end of the 52-week range with a yield of 2.21% and a forward P of 41. Over the last year, up 2%. Over the last 10 years, another one that is significantly outperformed, up 236%. We also note over the last 4 quarters, 2 beats and 2 in line, with their more recent one a marginal beat. Now over the next 4 quarters, they are anticipating some decrease, although Q1 26 we do get that double-digit increase. Nonetheless, they're anticipating overall earnings per share to continue to increase on a year-on-year basis, with the forward P in March 26 to come down to 24.06. Now, dividend safety, 60, borderline safe, massive growth, in fact, to their dividend at 33% just over the last full year. And when we do take a look at the last recession, well, they increased the dividend, they had below average growth, but they did outperform the S&P with their negative 40%. Another one with very nice historical growth to the dividend, 18% over the last 5 and the last 20 years, with 21 years of consecutive increases, meaning they are 4 years away from dividend aristocrat status. Now we get an undervaluation signal on the yield, 2.25 above the 5-year 1.63, although we do note the forward P does sit substantially higher than the 5-year 17, as well as higher than the information technology sector. In terms of the free cash flow payout, well, below 50% every single year, so no surprises while we have that double-digit growth, although over the next 12 it is anticipated to climb to 69, so we may not get a lot of growth over the next 4 years increase. In terms of the free cash flow, well, pretty consistent over longer term, although we do want to point out over the next 12 months, it is anticipated to drop to 264. And when we look at the sales growth, another one with some strong historical performance. And as we have seen, 2024, or the most recent year, for the majority of these, haven't been the greatest, down 10%, which does make us believe it could be an opportunity to capitalize on the higher quality companies. And over the longer term, nearly quadrupled their top line, although one similar to others today that have diluted your position as a shareholder over the last 10 years, but fairly trivially. And as we have seen, they have outperformed the S&P, so you probably wouldn't be worried too much. Then we get to the ROIC, a little bit of inconsistency. The last 3 years, though, do look very good, especially if they can maintain that consistency. And we can see more often than not, they are hitting that minimum 16% target, and in fact have increased from 21 to 34% in 2024, with the free cash flow margin probably being the best one we have seen in terms of very high numbers and very consistently around the 30s year on year. Now, in terms of the net debt to EBITDA, this one isn't the greatest. It has gone as high as 4.38 in 2019, although we do see it come down to 1.6 in 2024 and anticipate it over the next 12 months to increase, which is why we did in fact see that dividend safety score is above. Do bear in mind though, hopefully when we do look at their more recent quarters and their annual reports, this is something that we want to see load, and maybe they will take that into consideration. Now, our intrinsic value is higher than Wall Street. We have $112. Wall Street just below 100. However, we do note that 24% upside. And when we run it through the MOS level, well, a buy at 10% at $100, a buy at 15% at 95. And we can see in today's episode, if you are looking to add this, we see not at that 30% level just yet, but somewhere between 25 to 30. And as we said, Wall Street seeing 24% over the next year. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, and also joining us in the Patreon if you do want to run through our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.